are actually closer to meeting the Maastricht criteria than many countries that have been in monetary union for many years. So one might be tempted to say, and I know we've got European Central Bank representatives here, so I have to be careful what I'm saying, but one might be tempted to say it's not a question of when Hungary will join the euro area, it's a question of when the euro area will join Hungary. You're setting a good standard, I think. And I know we're going to go into these issues of the public debt and the structure, maturity structure, very important, the FX side. That's meat and drink to us, so we'll be looking at all that. My own feeling is that the further you go away from Europe, if you start touring Asia, shall we say, the more receptiveness you will find, because they want to diversify some of their holdings into other currencies. I'm sure you know that, but I do think it's a very useful tip that you can take those slides around the world, I think. I think you'll get a very, very good reception. I know the Debt Management Agency is doing things like that anyway, and we are certainly ready to help do those things too. Now, I want to now introduce Barnabás Virág, who I mentioned before. Of course, he's now taken over this international portfolio, but he's also carrying on with the domestic monetary policy and the financial stability. He doesn't look tired at all, but he'll soon be like Hans-Dietrich Genscher, the archetypal German foreign minister, who used to meet himself coming back on aeroplanes. They used to be traveling around so much. So Barnabás, you've just taken on this job. You've got a very important portfolio, but you're of the same size in terms of your height as Paul Volcker. So I'm pretty sure that sooner or later you'll become just as big a hallmark of stability and resilience as Paul Volcker is. So looking forward very much to what you have to say. Whenever Barnabás comes into the room with his very big size, you feel a burst of confidence coming over you. So Barnabás, over to you.
Good morning, ladies and gentlemen. Thank you very much, David, for the very kind introduction. Dear Finance Minister, dear distinguished guests, ladies and gentlemen, it's a pleasure to be here. I have to say that I'm in a tough situation after a very wide and comprehensive presentation we heard from the Minister. But I try to deliver my best and to say some news about the regional developments and about the Hungarian issues. In my presentation, I want to focus on our public enemy. And we know well that the public enemy in the last 2.5 years was the inflation in the world. And of course, as I'm responsible for monetary policy department within the central bank, and I promised several times that you can expect very clear communication about the Hungarian monetary policy, and I know well that many investors and journalists are here in the room waiting for some new message about the Hungarian monetary policy. So I promise I will deliver some new message about the Hungarian monetary policy, but of course, as in case in a new book, only on the last page of the presentation. Okay, starting with the title of the presentation, Battle Against Inflation, Where We Stand Now and What Next. So starting with the regional developments, as I mentioned, the high inflation period globally and in Europe started somewhere in the first half of 2021. So now we have some historical data, some historical perspective about the story. And when I heard from our Western European colleagues that, okay, this pretty high inflation period was a big issue in our country, I'm always saying that, yeah, it's maybe it was a big issue in your country, but it was a nightmare. It was a disaster for the Central Eastern European and for the Baltic countries. So you can see in that chart that why the European average inflation in the last 2 years, so since the mid of 2021, was 17% In case of the Western European countries, it was 15.6%. In case of the Central Eastern European countries, this number is near 30%. So near double of those inflation numbers we saw in case of the Western European countries. So I think for the Central Eastern European countries, this battle against the high inflation is a big and very important battle, because otherwise we are not able to continue our catching up story in midterm. If I look at the pattern, it's pretty interesting to see that in case of the Eurozone countries, we have a very symmetric inflation path. So as I mentioned, the inflation succeeded the 2% line somewhere in mid of 2021. So after that, it took 15 months till the peak. It occurred somewhere at the end of 2022. And after that, we can see a declining path, and as I mentioned, a very symmetric way. Of course, now the Eurozone inflation is 2.9%, and now we are waiting for the last mile. We will see when the Eurozone can deliver this last mile. What's the situation in case of the Central Eastern European countries, in case of the new members who joined to the European Union after 2004? We can see something similar, but in a much higher level. We reached a peak somewhere in the last quarter of 2022, in the Hungarian cases in the first months of 2023, but after that, in the region, a short plateau came, and the disinflation started in a very robust way only in the first quarter of 2023. So nowadays, the average inflation in the region is around 6 to 7%. Minister Varga mentioned that in our case, in Hungary, the October data was 9.9%, so we joined to the club where the inflation is again in the single-digit territory. And I'm very certain that we will continue our track towards the regional averages in the coming months. So these are the growth numbers. As the minister mentioned, the recovery from the COVID-19 crisis in the region was pretty fast, very robust. So these numbers show the GDP levels relative to the pre-COVID situation in the middle of 2021, so on that era where the high inflation period started in Europe. So you can see that the regional countries performed in a better way than the EU average. But it's worth to look at the case after that. So as the high inflation appeared in the region, it held back the growth in the last 2 years. So in many cases, in case of the regional countries, we saw weaker growth numbers in the last 2 years than the EU average. So that's why I'm saying it's a key battle for the regional economies to combat successfully against the high inflation we had. The other story elements in our region is the external balance. So of course, in case of the Central Eastern European countries, the energy intensity is higher than the EU average on the one hand, and on the other hand, we are net energy importers. So in line with that, the high energy prices we saw in 2022 made a big damage on our current account position everywhere in the region. Good news again that since the end of 2022, we can see a very sharp improvement in the field of current account position, especially in case of Hungary. So in the second and I think also in the third quarter of this year, the current account position of the country jumped to the positive territory, to the surplus territory again, which is needed in case of a balanced growth path. The big, very positive trend is the labor market, as the minister mentioned. So we can see everywhere in the region that the labor market remained tight during this recessionary period. I think generally it's a very, very interesting question. So how we can explain that 10 years ago we talked about a conference like this, we talked about the jobless recovery, we talked about the jobless growth, and nowadays we are talking about job-rich recession. I have two explanations for that. The first one is linked to the supply side. So, of course, the demographic trends started to play against the labor market situation. So nowadays, of course, the demographic trends turn to the aging side in the region, which cause structurally tighter labor market conditions everywhere. And the other explanation is linked to the profit situation of the firms. So we saw, especially here in Hungary, but I think in case of many other countries in the region, that in the last 2 years, during the period of high inflation, many firms were able to increase their own profitability. So they raised the prices, the consumer prices, to a much higher level that it was driven. Relative to that level, it was driven by the cost side of their operation. So that's why I think nowadays the firms have room for maneuver for labor hoarding, and of course they can use this room in the coming years to compensate the relatively high nominal wage growth, which is also expected in the region. So let's say some words about the credit market developments. So we can see a lot of similarities on that field. So the credit markets are generally cooling down in both in the households and in the corporate segment. But it's also worth to mention that the numbers are pretty similar, while the interest rates are different. So in some cases, the interest rate, as here in Hungary, is still in the double-digit territory. In some cases, around 7%. In case of the Eurozone countries, around 4%. But the numbers are pretty similar. Sending the message, the key driver behind the credit market development is the demand environment, is the uncertainty regarding the future. So as soon as the demand will turn, as soon as the uncertainties will start to diminish, looking ahead, I think we will have a good chance for a turnaround in the credit market developments. So we can see very similar numbers in the corporate sector. So you can see the red line is the Hungary, the green line is the Visegradian average, and the black line is the Eurozone average. So you can see very similar paths in the credit markets. Let's say some words about the current global issues, because of course we are all open economies, strongly linked to the European economy, strongly linked to the global financial markets. So I would like to say some words about the global issues. Okay, starting again with the inflation. As I mentioned, that's the public enemy. But that was the public enemy in the last couple of years. So we can see a clear downward path in case of the big economies in the Eurozone, in US, and also in China. I think the Chinese numbers are pretty important as one of the key exporters of the world, and we can see near zero, slightly in the negative territory, inflation in the last more than half year in China. So I think, or I can imagine that at some point China will start to export this low inflation to their own partners. Which can generate also this inflationary path globally. But all in all, the inflation is around 3% also in the US and in the Eurozone. So we can say, maybe we can see the first lights at the end of the tunnel. So till now, it was a big question mark. The big central banks can reach their own inflation target or not after this very high inflation period. I think it's pretty hard to answer that question, but I think nowadays we can be more optimistic regarding that. What can we see? What's the main driver of the financial markets? Of course, the very high long-term yield environment we have in the developed world. Both the US and German yields rise to a high level. If I compare the numbers to those developments I saw in the last decade, of course there was some correction in the last couple of weeks, but these yields are still high, and of course can generate a new era for the emerging world. So that's why I'm always saying that we have to be pretty cautious, because the yield environment in the developed world changed very rapidly, and I think we know well from the history, when the yield environment change very rapidly in the developed world, it can generate, non-expected waves in the emerging markets. So that's why we need a very cautious approach in our policy. A new phenomenon is the positive real interest rate environment also in the developed world. So you can see the numbers in case of the major economies. So the real interest rates are deeply in the positive side, both in the US, in the Eurozone, and also in China. So of course, it's a pretty important message to the emerging markets. You have to put more focus on your own real interest rate path. So that's why we emphasize several times in the Hungarian case, we have to deliver a positive real interest rate environment nowadays, first to continue the disinflation and to react for those developments we saw in the developed world. I don't want to talk too much about the geopolitical tensions, because I'm not an expert in geopolitics, but of course the geopolitical tensions have a big influence on our life. I think it increased the uncertainty, it increased the volatility in the markets. So I think we have to know that these geopolitical tensions are not only a transitory phenomenon, maybe it can be a more permanent part of our life in this decade. So finally, I would like to say some words about the Hungarian story, and as I mentioned, some words about the Hungarian monetary policy. I absolutely agree with the presentation we saw from Minister Varga. So in the side of inflation, we made a very big step in this year. The Hungarian inflation peaked about 25% in January. It was 9.9% in October. And I think we have a good chance to reach around 7% in December. But in my view, I think we have a good chance to have a number in December below 7%. But of course, it strongly depends on the oil market developments. So that's why I'm emphasizing based on the currently available information. So of course, it's pretty hard to see how the oil markets will react on the geopolitical tensions we have. So all in all, if I compare the Hungarian numbers to the historical evidences, to those evidences in the history where we saw inflation about 20%, we can say that we are on the side of winners. So we are moving in the green territory, in that territory where the countries were able to regain the price stability, were able to regain the low inflation territory. If I look at the current underlying inflationary numbers, I think it's worth to put more emphasis on the month-on-month and 3-month-on-3-month indicators, especially in case of the core inflation. So if I look at the numbers, it's pretty clear that the price decisions changed very significantly in the last half year. So the month-on-month core inflation is the pattern of the month-on-month core inflation is pretty similar to that one we saw before the COVID-19 crisis, and also the 3-month-on-3-month indicators are near to 3% to that level we saw also before the COVID-19 crisis. So that's why I'm saying at the end of this year, I'm quite sure that the Hungarian inflation will be in the range of the regional averages. So I think till now that was the headline, that the Hungarian inflation is the highest within the European Union. But I think in the coming months, these headlines will change, and the Hungarian inflation will turn back to that territory where the peer countries are. So this chart shows the cumulative price changes since the December of 2022. It's around 6%, which is again in the middle of the regional numbers. So that's the forecast of the central bank we published in September. So I mentioned the December data can be around 7%. Till now, I said can be somewhere between 7 to 8%, but based on those information I saw in the September and October data, and based on that information I saw in the global oil market, I think the end of the year data can be around 7%, but I think, so that's my view, we have a good chance to have a lower number than 7% in December. Some words about the growth. I think as inflation falls, we have a good chance to continue our growth in a balanced structure. So I think we need a balanced economic growth from the next year. And I think we have also a good chance. Why? Because as the inflation falls, the real income and the real wages start to grow again. It started to grow in September. It will continue in the next year. I think the real wage growth can be around 4 to 5% in the next year. The second pillar is the investment decisions. In the last 2 years, especially in the last 1.5 years, we saw the firms and also the government postponed a lot of projects. So looking ahead in a more normalized demand environment, I think these players will start to realize these postponed projects, which can add the economic growth in 2024 and 2025. And the third element is the export side of the economy. Of course, I know well that there are nowadays downside risk in the global demand environment, but on the other hand, we invited a lot of new FDI into the country in the last couple of years, and nowadays these new FDI capacities are turning to the production phases. So it will add an extra boost to the Hungarian exports. So that's why I think we have a good chance to grow in a range between 3 to 4% in the next 2 years in a balanced structure. Some words about the current account position. I mentioned it. I think it's one of the key story elements in case of Hungary. I'm always saying that when the current account position of a country hits -7, -8% range, it's pretty hard to stabilize the markets. And in the last year, in 2022, we were in that situation because the current account deficit of the country was more than 8%. So now, as I mentioned, we can see a big improvement in that field. I think in this year, the current account position of the country can be near to zero and will jump to the positive side, positive territory in the next year. So why I repeated our numbers from the last financial crisis, from 2008 and 2009, because the improvement we can see nowadays is faster than on that situation. So I think, again, we are in a good track to regain our stability in the external position. So finally, I would like to touch the monetary policy, as I promised. So again, the real interest rate turned to the positive territory in the last 2 months. And looking at the facts we had from the developed world, the positive interest rate is needed to continue the disinflation and to stabilize our markets. So of course, the positive interest rate helps to achieve the inflation target. So if I take into account the very fast disinflation which is expected in Hungary in the coming months and in the coming years, we have a good chance to provide this positive interest rate environment for the further disinflation. In October, the monetary policy entered into new phases after the normalization phase. So within this new phase, we will focus on the macro fundamentals. As I mentioned, we had many positive signals and positive shifts in case of the macro fundamentals, in case of inflation, in case of current account developments. the GDP started to recover from the recession, but also we have to take into account the financial market developments we have globally. So the goal of the central bank, the goal of the monetary policy is to create an interest rate path that ensures the continued disinflation and the stability in our financial markets. And of course, at the end of the day, at the end of this road, the interest rate environment will support the recovery of market lending in 2024 and stimulate economic growth. So let's say some words about numbers. Of course, again, so we cannot sit back. The inflation target of Hungary is 3%, so the numbers are still above the inflation target. So we cannot sit back because we are flying in a very turbulent weather conditions if I look at the global market developments. So the MMB will continue to use a data-driven and careful approach in their decisions. If I look at the numbers, I can say the incoming inflation data in October was below our expectation, was better than the expectations. Again, the oil prices are lower than previously assumed. And nowadays, the firms will get their own new energy contracts. And I think these new energy contracts will reflect that better energy price environment we had in the last year. The external balance position improved sharply. So I think we will reach the positive territory. We will be very close to the positive territory in this year, if I look at the whole year average. But we have to know the risk environment remains uncertain, so we have still geopolitical tensions. There are global recessionary fears. But if I look at the developments in the last 2-3 weeks, the elevated long-term yields in advanced economies started to decline. And there was also some changes in the persistently tight international monetary policy environment, so the bets on rate cutting appeared on the horizon. Of course, I don't want to overreact these developments, but that's the news. So again, we are flying in a very turbulent weather conditions, so the volatility is still the part of our life. So data-driven and careful approach is still needed. What does it mean for the coming months? I think based on the currently available data, the continuation of the base rate cuts is supported by the current environment. So if I look at the macro data, if I look at the financial indicators, it's pretty clear that the monetary policy will continue the base rate cuts. The current environment supports the continuation of the rate cuts at an unchanged pace of 75 basis points in November. And based on the current realistic scenarios, the interest rate could fall below 11% by the end of the year. So till now, I mentioned it can be around 11%. So based on the currently available information, I think the interest rate could fall below 11% by the end of the year. I always get the question, okay, we have a single-digit inflation now, when the base rate can step into the single-digit territory. So now I can say, based on the currently available information again, the single-digit base rate emerged on the horizon, and I think it's realistic to expect that the base rate can reach the single-digit territory in February 2024. Looking ahead, again, it's still key. The real interest rates remains in the positive territory, so we will deliver that. And when setting the level of real interest rate, we focus on two factors. The continuation of disinflation, so it's a need. The lower the inflation is, the stronger the recovery in the domestic demand will be. And the other element is the developments in risk environment. So of course, we know we are flying in a very turbulent weather conditions. So now that's why we have to need a data-driven approach, assessing the global market developments, I can say, a daily basis. But that's the picture we have now. Thank you very much for the kind attention, and I also wish very fruitful conversations for the day.